So good morning, guys. We're just going to continue our discussion on long-term assets, but now we're going to focus on intangible assets. So intangible assets are those assets that you cannot physically touch, and they are extremely important to the organization. However, they are unlike furniture or buildings or car. They are really intangible. They can include such things as rights, privileges, and they basically give you rights, privileges, and competitive advantages over other companies or over other businesses, and you are the owner of those long-term assets as a company. In general, the accounting for intangible assets is very similar to the accounting for tangible assets. You record them at purchase cost. You can revalue them if you need to in the future, and you amortize them over their useful life. But the question arises, how do you actually come up with a useful life for these intangible assets? So we can talk about that in the next couple of slides. But before we do, let's look at some of the intangible assets that can be amortized, because there are some that cannot be amortized. So, amortized, the ones that are amortizable, as you can see, have defined lives. So, in order for you to amortize them, you've got to have some kind of a life for these assets. And usually, actually most of the time, usually 99 to 100% of the time, they are, the straight line method is used, because you can't really do units of activity for an intangible asset. You're not sure how to apply that. Declining balance is another method that can be used, but usually is straight line method. So some of the examples for those intangible assets that are amortizable are patents, and legally they have a life of 20 years. Sometimes they can have a life of less than 20 years, so then you would amortize them for that number of years that the government has given you the patent for. Copyright's life is whatever the life of the copyright is plus 50 years, so that can be obviously a long life. R&D costs, research and development costs, so you can produce a new product, innovate a product, and spend lots of money on researching and developing that product. So what will happen is you will then have to come up with the life of that product, and you will amortize R&D based on the life of that product. Franchise, number of years of the contract. So if you were to franchise, for example, McDonald's restaurant, one of the locations, you would have a defined life, 10 years, 20 years. You can amortize the franchise cost during that time. Tim Hortons is a big franchise business in Canada, and a lot of, actually close to 90% of those Tim Hortons are franchised.
What about the other 10%?
What about the
Other 10%?
other 10% are owned by the main company, and they don't want to franchise them for emotional, for other side reasons. For example, probably their first few locations or the biggest locations and stuff like that. License is the number of years of license that you hold that can be amortized over that number of years. For example, some of the Ministry of Transportation locations are licensed to individual owners, and they're licensed for 10, 15, 20, 30 years. So you would amortize that license cost over those number of years. Some that are not amortizable include Goodwill and Trademarks. So they do not really have a definite life. They are indefinitely yours, and you do not amortize for them. However, there is a test for impairment, which we'll come to in a second. So goodwill, what is goodwill? Goodwill can include lots and lots of things, but basically what it includes is, as you can see here, includes the value given to the reputation of the company. Yeah? So this is, the number of customers you've had, the clients you have, the reputation, the image you have in your business, all of that forms goodwill. It can also include things like brand value, customer loyalty, and stuff of that nature. it is extremely difficult to put a dollar value on goodwill. So we'll come to this in a couple of minutes. Let's go back to this slide. So financial statement presentation for intangible assets. It's very similar to tangible assets. You put them under long-term assets. As you can see, you've got PP&E, which is your tangible assets, and then you have other tangible assets, and then the third line will be intangible assets, and you will put all your intangible assets on that line and then break it down in the notes section. The amortization methods used are also described and disclosed in the notes, and the dollar amounts are also disclosed in the notes. So coming back to goodwill. Goodwill is one of those things that is very debatable. How do you put a value on goodwill? You really cannot. So it's very, very tough. You've got to look for outside consultants. You've got to have different mechanisms in order for you to value goodwill. First of all, goodwill cannot be valued just because you want it to be valued. So you've got to have a transaction happen. And this transaction would be to purchase or to sell your business. So if you are purchasing a business, an existing business, it will have goodwill. If you are selling your business, it will have goodwill. It can be a small business, it can be a medium business, it can be a large business. All these businesses that are established have some kind of goodwill because that's the value that the purchaser is willing to give you. Right? So what happens is, this is how you calculate goodwill. Goodwill equals purchase price minus the fair market value of your assets. So let's say you own a store, a convenience store. You've got inventory of $100,000 and you've got all other assets including computers, furniture of $10,000. So altogether it's $110,000. But when you sell it, because you've got a location, you've got an existing customer base, everyone in that area comes to your convenience store, you've got great image, you've got a lot of reputation, the value of your store is $200,000. So the purchaser pays you $200,000, yet your assets are worth $110,000. So the difference, the $90,000 difference is goodwill. How do you record that? Obviously you can see the $90,000 you would record it as debit goodwill in your books as a purchaser, and you would credit cash or AP in your books. Okay? So goodwill now becomes part of your business because you purchased this business. So goodwill has a value on your business, on your statements. But there will be no amortization of goodwill. There will be a test for impairment. The reason there's no amortization is because it's so difficult to value goodwill to begin with. How can you amortize goodwill? You're not sure how it's going to go up or down. So but you do a test for impairment every year. What this test for impairment includes is an expert looking at the goodwill that you've recorded. Has it gone up or down? If it has gone up, what happens? There is no change in the value of the goodwill. Right? Because it's only gone up based on the outside consultant's value and understanding, assessment, and you do not just arbitrarily increase the value of goodwill on your books. However, if it's gone down, you must decrease the value of the goodwill because the principle of conservatism applies. Okay? So you've got to decrease the value of the goodwill if it's gone down. If it goes down, you would debit goodwill impairment loss and credit goodwill directly. When can a value of the goodwill go up? Only when you then sell your business later on and there's a higher value of goodwill. At that point the value of the goodwill would go up, but not for you, but for the business that's purchased your business. Okay? So I just wanted to cover the intangible assets and look at goodwill specifically, and the test for impairment and the recording of transactions. I have left lots of information in the pickup folder for you to pick up and understand and read about goodwill. So we'll stop it here and we'll continue with the next chapter in a couple of days. Thank you.